You are listening to C-Suite Perspectives, a podcast by the Conference Board.
Welcome to C-Suite Perspectives, a signature series by the Conference Board. I'm Erik Lundh, Senior Global Economist for the Conference Board and guest host of today's episode. Joining me today is Stephanie Guichard, Senior Economist of Global Indicators at TCB. In today's conversation, we'll discuss the latest U.S. Consumer Confidence Index, as well as our outlook for the global economy. Welcome, Stephanie.
Hi, Erik. Nice to be here.
So let's dive straight in and talk a little bit about the Consumer Confidence Index that was released this morning. What were the biggest takeaways from the January reading?
Okay, so consumer confidence has been moving sideways in a relatively narrow range since 2022. And the big takeaway is that January was no exception. So the index weakened for the second straight month, but it still remained in that range. It's just now in the lower part of the range. So while we've seen month-to-month fluctuation, the index has never been able to break free of that range, nor on the upside, nor on the downside.
Okay. Can you tell us a little bit more about what happened this month in terms of the details?
Yeah, sure. So the CCI retreated. We have a 5.4-point decline in January, which is coming after a 3.3 decline in December. So overall, we have 2 months of decline in the CTI, and it has lost about 2/3 of the gains from the previous 2 months. So now the index is, as I said earlier, the index is back in the lower part of the range that has been prevailing for the past 2 years.
What caused movements in the overall measure?
So the decline was broad-based. The 5 components of the index deteriorated in January. So we saw some decline in both consumer optimism about the present situation and about their expectations for the future. However, just to say it now, the largest drop was for the present situation.
And what drove the change in the present situation?
So the present situation fell sharply by 9.7 points. And what we saw is the assessment of business condition weakened for the second month in a row. But more importantly, views of current labor market conditions fell for the first time since September. So usually, consumer confidence, especially their views of the labor market, they tend to reflect quite closely what's happening to job openings and to the unemployment rate. So this month, what we saw is likely a slight correction. We had very strong improvement in consumers' views about the labor market between September and December, and maybe they overestimated the improvements in the labor market during that time. So in January, there was a correction.
And so what about the expectations measure? What influenced that?
We have 3 components in the expectation measure. So we have future business condition. Consumers are still optimistic about future business condition, but a bit less than in December. We also have future income. And again, consumers are still optimistic about future income, but a bit less than in December. And last, we have future conditions on the labor market. And this measure shows some optimism at the end of last year, like October, November, and then it turned back into pessimistic territory in December, and this pessimism was a bit more exacerbated in January. So it's really the 3 components went down, but the one that is, the most negative is expectation about the future labor market.
So what about the inflation story? It's something that we're still tracking quite closely. Is sticky inflation affecting consumers' view of the future of inflation, interest rates?
So in the survey, we are tracking consumers' inflation expectations for the next 12 months. And indeed, it seems that, the stickiness of inflation has started to affect consumers' view. We had some declines in the second half of 2024, but what we saw is an uptick in January. So consumer expectations moved up on average from 5.1% to 5.3%. And this is likely reflecting, the less favorable than expected trend on inflation in recent months. Additionally, I wanted to mention, consumers are still talking a lot about inflation and prices in our writing responses. So we have this open question asking consumers what's affecting the most their views of the economy right now, and inflation and prices are still on top.
So was there any good news in the survey this month?
There was some good news in the survey. And first, I would like to mention that consumers' views about the risk of recession haven't changed. They are still among the lowest reading than since we started to ask the question a few years ago. Second, consumers' views about their family financial situation now has improved, and it's at 18 months high. And it's even better regarding their expectation for future family financial situation, which has now reached a series high. So it's kind of mixed feeling about consumers. As I mentioned earlier, they were a bit more pessimistic about, the future of employment, the future of income, the future of business situation, but they are still very optimistic about their financial situation going forward, which is likely reflecting some mixed feelings, but it may also reflect another positive development in the survey, which is the stock market. So what we saw in recent months is that consumers are very bullish about the stock market. They are a bit less bullish in January than they were in prior months, but it's still near a record high for this series that we started in 1987. So bottom line, consumers have never been so optimistic about the stock market than in the past few months. And we have over half of all the consumers expecting stock market continuing to increase going forward, and only like 23% expecting stock prices to decline.
So beyond the month-to-month changes that we've been talking about, what's sort of the big picture takeaway that we're getting out of the CCI these days?
On the survey, the big picture is quite simple. Our confidence measure remains bound range in this relatively narrow range where it has been for the past 2 years. And, in that range, consumers are relatively happy about the present, although a bit less this month than in previous months. And they are worried about the future, especially the labor market. So this is kind of the big picture of our index.
In terms of the write-ins, were there any interesting write-in comments beyond the references sort of to inflation that you already mentioned?
So second to inflation, what's affecting the most consumers' view about the economy are references to politics. It's interesting because during this election cycle, references to politics were lagging behind the past two electoral cycles. So there were, we didn't see as much references to politics up to the summer if you compare to 2020 or 2016. Since November, consumers have been talking more about politics. So now references to politics are above the 2020 cycle, but still below the 2016. And that's really, the second most mentioned issue, like politics after inflation. Besides that, we don't see any major changes and many big references.
What about consumers' buying plans regarding things like homes and durable goods?
So let me just mention, we look at this data on a 6 months moving average basis because it's quite volatile month to month. So what we saw in January on the 6 months basis is that buying plans for homes and for cars were quite flat. There has been some increases in the past few months, and now it's kind of flattened out. If you look at the other durables, we have overall more consumers saying that they plan to buy big ticket items over the past 6 months than consumers saying that they are not going to buy it. However, when we look at the different appliances or electronics, and we ask consumers, are you going to buy a fridge in the next 6 months? Are you going to buy a TV? Are you going to buy a smartphone? They are all not looking very good. We saw some stabilization or some decline in buying intentions.
And what about services?
So services, I mean, consumers are still continuing to express intention to buy more services going forward, and it's especially the case for dining out and streaming. On the other hand, they are much less interested in going to the movies, going to sporting events. So we can see a kind of substitution from something that's relatively expensive, going out to a sporting event or even to the movie theater, versus watching it from your home, where you just need to pay a subscription to a streaming service, and they are willing to spend more on streaming services than on going to the events. And it's really in our mind a price story. We also saw more intentions to spend on hotels and on travel, but at the same time, consumers are telling us they are not planning so much to go on vacation. So most likely, they are planning to spend more when they go on vacation, but they will be going on vacation less often than in the past few years.
And then finally, what does consumer confidence tell us about household spending this year in 2025?
So overall, as I mentioned already, consumer confidence has been relatively bound in this range. So the reading for January is very close to the 2024 average. In a way, you could think about it like things haven't really changed in last year. What we saw last year is consumer kept on spending. So most likely, from our survey, unless something changes, they are still going to spend. And the main reason is, as long as people have jobs, as long as, they get their paycheck at the end of the month, they keep on spending. We had a few instances last year where consumers told us, well, we want to save more money, we're going to spend less. But when you look at the data, this is not what they did. So, consumer tend to always surprise us on the upside. And as long as the labor market remains strong, which it's, I think, our main forecast, consumers are going to keep spending. That's my main takeaway of the survey.
Well, thanks very much, Stephanie. We're going to take a short break and be right back with more of our conversation.
What does the future of work mean for your employees? How will your company navigate ESG? Will there be a global recession? At the Conference Board, our experts translate the latest research and economic analysis into insights and real-time problem solving for your organization. Membership at the Conference Board provides your team with an assortment of knowledge, from economics, marketing and communications, ESG, public policy, and human capital. As a member, you'll have access to our center experts, member-exclusive events, data and benchmarking tools, and peer sharing that will help you understand the present and shape the future. Consider becoming a Conference Board member today by visiting www.conference-board.org.
Welcome to C-Suite Perspectives. I'm Stephanie Guichard, Senior Economist at the Conference Board, and I'm joined by Erik Lundh, also Senior Economist at TCB. And, after this conversation on the consumer confidence, we're going to turn the table, and I'm going to ask Erik questions about our outlook for the global economy. So let's start with the US economy. So is the US on track for another year of solid growth?
So we are forecasting that the U.S. economy grows by about 2.3% this year versus about 2.8% in 2024. So while this is a slower growth rate than the one that we've experienced in recent years, it's still a pretty good one. Trend U.S. growth is just under 2%. So we'll continue to beat that at least for 2025 or so. The strength of the U.S. consumer is one of the big parts of this story, as you were just discussing, Stephanie. We still see robust spending in early 2025, really carrying over from last year. However, moving a little bit towards the end of this year, we're expecting to see that spending moderate a little bit, especially because interest rates aren't going to fall as much as we had previously forecasted, given some trends that we're seeing in inflation and in the job market.
Thanks, Erik. So can you tell us a bit more of why interest rates are not going to fall as much as was expected, like, say, a year ago?
Sure. Well, I mean, in short, it's because inflation isn't dropping as fast as the Fed and the markets and indeed the conference board expected. And a lot of that has to do with the fact that the labor market remains fairly tight. The progress that we've seen in recent inflation reports appears to have stalled a little bit, despite the Fed's effort to bring it back to 2%, which is the Fed's inflation target. And then on top of that, with the new administration coming into the White House, we have a whole new set of policies that do actually have the potential to be inflationary as well. And so, as a function of all this, we're expecting inflation to cool, but just more gradually than we had previously thought, and that interest rates, as a function of that, are going to stay higher for a longer period of time.
Thanks, Erik. So let's move to the global economy. So what's our outlook for the global economy as we enter 2025?
So we're forecasting 2025 GDP growth of about 3.1%, which is roughly on par with what it was in 2024. So at this point, we're expecting to see top line growth stay somewhat stable for the year. But looking out further into 2026 and beyond, we think that the global economy is going to slow somewhat as some of the sort of larger demographic trends increasingly weigh on economies around the world. And we wrote about this in our Global Economic Outlook at the end of 2024, if you're interested.
So let's look into the different region, and I would like to start with Europe. So do we finally see some improvement in Europe?
So the euro area economy enters 2025 on a fairly weak note, but growth this year should be somewhat better than it was last. High energy prices and weaker demand will keep weighing on the manufacturing sector in Europe. Political and policy uncertainty could also further dampen business and consumer sentiment. And the prospect of higher tariffs, of course, can further impact the economy there. But on the upside, a robust labor market, strengthened real wages, and less restrictive monetary policies are all expected to support the economy across the Atlantic. Following below trend growth of around 0.8% in 2024, the euro area economy is projected to recover modestly to about 0.8% this year.
Okay, thank you. So let's continue going around the globe, and maybe let's talk about emerging market. And there are plenty of them, so let's focus on the biggest ones, India and China. So what's
Sure.
our forecast for 2025 and 2026?
So our China forecast remains unchanged at 4.5% for 2025. We recently got in the full year growth numbers for 2024, which came in at the government target of about 5% growth. We had forecasted it was going to slow to 4.8, but we didn't see that according to the just published data. Given some of the decisions that were made at the Central Economic Work Conference late last year, we expect growth in 25 to benefit from stronger fiscal and monetary policy support. And this could push the Chinese economy actually even higher than our growth forecast of that 4.5%. Though it remains to be seen how effective the support will be in expanding domestic demand, especially consumer spending, given some of the underlying structural weaknesses that are dragging consumer confidence in China down. On India, despite a fairly robust 5.3% year-over-year growth rate in Q3, India's economy has actually been on a deceleration course over the course of 2024. It was growing even faster earlier in the year. Private consumption contracted quarter on quarter in Q3, following really 2 years of expansion. Elevated inflation is continuing to weigh on spending. We're also seeing weaker industrial growth in the country. And according to the Reserve Bank of India, these themes may persist into 2025 as India's growth rate continues to moderate somewhat.
Okay, thank you. And I would like to conclude about the risk surrounding this global forecast. And you mentioned already several times the US tariff. So maybe you can tell us a bit more, and more globally, you can tell us a bit more about the risks surrounding your forecast in general.
No, I mean, the tariff one is one of the larger sort of variables that could go really either way. It's a big question for 2025. The new administration's campaigned on implementing a variety of new tariffs on countries like China, Canada, and Mexico, and even potentially sort of broad-based across the board tariffs on all U.S. imports. But since taking office, this has yet to happen. It's been discussed, but we actually haven't seen much in the way of actual policy action. But the threat remains. We're going to be watching it carefully. There could potentially be some tariffs implemented this coming weekend, or possibly in February as well. So we're going to have to really track sort of what is done and actually implemented, as opposed to just what's sort of being discussed. But in general, as you can imagine, countries that do have a large trade exposure to the U.S., which is a very large market, do sort of see the most potential for downside risk as a function of these tariffs.
And any other risk or upside, downside that you would like to mention before we close?
Well, I mean, there's always the upside risk that we see more progress on inflation, in which case we could see more monetary loosening, and not just in the U.S., but in other parts of the world as well. So that's certainly a one sort of positive a tailwind that is maybe not probable according to our current forecast, but is certainly possible.
Okay, great. I mean, this was a great conversation. Thank you so much, Erik, for being here with me today.
Yeah, it's great to be here.
Thanks to all of you for listening to C-Suite Perspectives. I'm Stephanie Guichard, and this series has been brought to you by the Conference Board.
You have been listening to C-Suite Perspectives, a podcast by the Conference Board.